Artificial intelligence or AI is sucking up trillions in capital. But here's the truth no one wants to say. Most revolutions start with a bubble. The question is whether this one bursts or builds an empire. Hey folks, in 1849, thousands of people rushed to California chasing gold. But only a few got rich. Not the miners, but the people selling the picks and shovels. Fast forward to 1999, the internet promised a new economy, and it delivered, but only after vaporizing trillions in the dot-com crash. Now it's AI's turn. History says every technological revolution starts with a frenzy, a mania. The winners aren't the loudest speculators, but those who understand which parts of the boom are real and which are hype. So today, we're putting AI through a hard-nosed, 5-part stress test to find out if this is a true economic transformation or the next financial hallucination. We're all seeing it. Billions, maybe even trillions of dollars are just flooding into artificial intelligence. And that leads to the one huge question on everyone's mind, right? Are we watching a truly world-changing economic boom take off? Or is this just an epic, overhyped bubble that's about to pop? I mean, let's be honest with ourselves. This feels a little familiar, doesn't it? We've seen this movie before. If you think about the railroad manias, the dot-com crash history is just littered with these kinds of speculative frenzy. So the real question is AI just the latest sequel in a long-running series, or is there something genuinely different this time around? Well, to even begin to answer that, we've got to get one thing straight. Not all booms are created equal. You've got two very different kinds. On one side, you have your dysfunctional bubbles. Think of the 2008 financial crisis, right? All built on hype and not much else. But then on the other side, you've got productive booms. These are driven by something real, a truly game-changing technology like the internet. Now, they can still get frothy, a little crazy for sure, but underneath all that froth, they're creating immense lasting value. So that's the million-dollar question. Which bucket does AI fit into? Okay, so to figure this out, we're going to put the current AI boom through a kind of rigorous health checkup. Here's how we're going to do it. First, we'll take a quick look at the lessons from history. Then I'll introduce a 5-gauge toolkit that experts use for this stuff. After that, we'll put AI through its own health checkup using that toolkit. And finally, we'll deliver the verdict, at least for now. All right, first up, lessons from history. You know, if we're going to figure out if this boom is the real deal, we have to compare it to the right historical moments, because not all booms are created equal. Okay, now this is really fascinating. What you're looking at here is the typical life cycle of a truly transformative technology. It starts with what's called an installation phase. You know, that's the wild speculative frenzy part. Then, and this is key, you often get a turning point, which is basically a crash, a bubble bursting. But, and here's the really crucial insight, that crash isn't the end of the story. It's often followed by a golden age of real sustainable growth. So for the biggest tech revolutions, a bubble bursting isn't even a failure. It can be a totally normal, even necessary part of the process. So that's the historical pattern. But how in the world can we tell where we are in that cycle right now in real time? Well, that's where our diagnostic toolkit comes in. You can think of these as the actual gauges and instruments that economists use to measure the health of a tech boom while it's happening. And here they are, our 5 gauges. We're going to look at economic strain, capital expenditure versus revenue, growth, valuation, discipline, and finally, funding quality. This is our roadmap. Let's dive in. Okay, time for the main event. Let's get AI up on the examination table and run these 5 tests. What does the health checkup reveal? First, gauge economic strain. This one asks a really simple but vital question. How much of the entire economic pie, The whole country's GDP is being eaten up by this one new technology. Because if that slice gets way too big, the whole economy can get warped and become dangerously dependent on just one thing. This chart really puts things into perspective. Look at this. At their absolute peaks, the railroad boom and the internet were both eating up close to 2% of the entire US GDP. Now look at generative AI in 2023, just 0.8%. So yeah, it feels massive to us right now, but its footprint on the whole economy is actually way smaller than those past revolutions were at their height. So what's the diagnosis for our first gauge? For now, the needle is firmly in the green. Yes, the demand on resources is high, but it's not at a dangerous systemic level for the economy. At least, not yet. Now, some projections show it could hit that 1.8% mark by 2027, which would push it into a cautionary yellow zone. But for now, it looks totally manageable. On to gauge number 2. This one is capital expenditure versus revenue. Now, capital expenditure, or CapEx, is just a fancy term for all the money being spent on stuff. The infrastructure, the data centers, the chips. This ratio is super important because it asks a simple question. Is the industry spending a ton more building things than it's actually earning from customers? A really high ratio here. That is a classic textbook warning sign of a bubble. And, okay, here's where we get our first red flag, or at least an amber one. Check this out. Back in the day, the railroads spent about $2 for every one they earned. The telecom boom in '99, about $4. Generative AI in 2023 spent almost $7 for every single dollar of revenue it brought in. Whoa, on the surface, that looks kind of scary, right? That ratio is seriously high. This quote here tells you exactly why that number should make us sit up and pay attention. In the past, this is how bubbles burst. The spending was enormous, but the revenue just came in way too slowly to justify it. The revenue growth ran out of steam, so that alarming 7-to-1 ratio we just saw, it raises what is probably the single most important question of this entire analysis. Can AI actually generate revenue fast enough to justify burning through all that cash? And that leads us perfectly into our third and maybe the most critical gauge of them all. Revenue growth. This is the whole ballgame. This is the potential cure, the antidote to all that crazy spending. Is the money coming in fast enough to actually close that huge gap we just saw? The answer so far is an absolutely massive yes. The forecasts are just staggering. We're talking about generative AI revenue, potentially doubling year over year. This isn't just fast. It's a rate of growth that absolutely dwarfs anything we saw in the early days of railroads or the internet. It's not even in the same league. So when you put those last two gauges together, it completely changes the picture. That sky-high spending, we were worried about it, suddenly starts to make a lot more sense. It's not just wild speculation happening in a vacuum. It actually looks like a rational response to truly explosive, maybe even unprecedented demand. Okay, let's move on to gauge number 4, valuation discipline. Plain and simple, are the prices of these companies grounded in reality, or have investors officially entered fantasy land? I mean, just think back to the dot-com bubble for a second. The PE ratio for the NASDAQ went over 100. That is completely unhinged from any kind of financial reality now, today. Yeah, some AI stocks are for sure expensive, but a huge chunk of the valuation is tied to the hyperscalers. You know, Microsoft, Google, Amazon companies with massive, tangible, real-world profits. Overall, the market just seems to be showing a lot more discipline this time. That brings us to our fifth and final gauge, funding quality. This one's all about where the money is coming from. Is this whole boom being funded by stable, long term cash from profitable companies? Or is it built on a house of cards made of fragile, speculative debt that could just vanish overnight? Well, the answer couldn't be clearer. Look, who's funding this thing? Microsoft, Amazon, Google, Meta, Nvidia. The AI boom is being bankrolled almost entirely by the internal cash flows of the most profitable companies the world has ever seen. This isn't a house of cards built on shaky debt. It's more like a fortress built on some of the strongest financial foundations in corporate history. All right, we've run all 5 tests. The AI health checkup is complete. So, what's the final verdict? Here it is, the final report card. And look at that. 4 out of our 5 gauges are solidly in the green. Economic strain, revenue growth, valuations, and funding quality all look healthy. The only one in the amber zone is that high CapEx to revenue ratio. And as we saw, even that seems justified by the absolutely incredible revenue growth. So the bottom line, at least for now, all the signs point to this being a productive, powerful, and so far surprisingly healthy techno-economic boom. So it seems the boom is real. This isn't just smoke and mirrors, which of course just leads us to the next massive question. The big question for the next chapter of this whole story: who's actually going to capture all of this value? Is it going to be the companies building the infrastructure? You know, the ones selling the picks and shovels in this gold rush? Or will the biggest winners be the people who build on top of it? All the ones who use that infrastructure to create the next wave of world-changing applications. If you found this breakdown valuable, subscribe right now, because every week we cut through the noise and show you where the real wealth is being built. No hype, no guessing. Just evidence, history, and strategy for investors who want to own the future, not chase it. Stay curious, stay rational, and I'll see you in the next one.